If you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 stock picks is Rob Burnett, manager of the Neptune European Opportunities Fund. Hello, Rob.
Hi.
So what's the first stock you have for us today?
I wanted to talk about Intesa Sanpaolo, an Italian bank with the number 1 market share in Italy. That this company is exceptionally well positioned to benefit from a recovery in the Italian economy. And it's pretty cheap. It trades below its book value, which is a good measure of intrinsic value, and it also pays a great dividend. The dividend next year will be over 5%. In 2016, it could even be an 8% dividend. So a very cheap company paying a good cash return with good earnings growth that's exceptionally well run.
I think a lot of investors may think it's cheap for a reason. You know, we've been told over the last 5 years to be wary of Italy and to be wary of banks, and here you are picking one that is both. Is the risk out of the way?
It's definitely one of the best risk-reward kind of moments probably in the last 20 years. And so there's no investment without risk, and there's certainly no bank investment without risk. But what can you lean on for support? Mainly the capital ratio. This is a bank with one of the highest capital ratios in the world, not just in Europe, with a Tier 1 capital ratio north of 12%, nearly 13%, which is exceptionally strong. So I would say there are, of course, risks investing in Italian banks, but assuming the economy continues to recover, and given how well capitalized it is, and given the dividend support you have today, not tomorrow, this is one of the lowest risk bank investments you can make in Europe.
And what's your second stock?
My second stock, I'm going to choose a company called GDF Suez, a diversified French utility, which does lots of different things, but one of its major areas of focus is in the gas sort of system. So they produce gas, they transmit it, they distribute it, they sell it in Europe and also in other parts of the world. They also generate some electricity, and they sell electricity in France, and they have a Latin American business too. Why is it interesting? It's also the dividend that's very important. The dividend here is 6%. But importantly, it's returning to growth. It's a company that hasn't grown really since the crisis, so really since 2007. But this year and next year, it's going back to growth of nearly 5 to 6% a year in terms of earnings growth. And it's really cheap, relative to the security of those earnings and the dividend it's going to give you. So I think it's a nice balance with the previous company we discussed, Intesa. You have a more steady utility, you have a slightly higher risk bank, but you know what? In both cases, they're paying you big dividends, which is wonderful for anyone seeking income.
And what's your third stock?
My third stock is a company a little less well known than the other two, a little smaller. It's a company called Galp, G-A-L-P, which is a Portuguese listed oil company, which has a series of different businesses. It has an oil refining and retailing business in the Iberian area. But what's exciting about it is actually its production in Brazil, oil production in Brazil. And Brazil has this incredible reserve, this resource in the Santos Basin. It's in the offshore Brazil. And Galp's production growth, beginning actually last year, but going out to 2020, is phenomenal. It's growing production at least 40% a year to 2020. And it is meaningfully undervalued relative to its oil reserves. And so that production growth that will accelerate this year, next year, out to 2020, will deliver you great earnings growth, and I think will deliver a higher share price.
You said why you think it's going to deliver a higher share price. The sector in general, oil, has not done well over the last couple of years. The oil majors have underperformed. Tullow Oil is trading way below its fair value estimate. So do you think these individual triggers are enough for investors to see upside?
I actually think the integrated oil sector is moving into a sweet spot anyway. So you're right, on a 3-year view, the integrated oil companies like Shell or Eni or Total haven't performed that well. But actually in the last 6 months, they've done quite well. And one of the reasons why I think that's the case is whilst the oil price itself hasn't moved that much, the market is now expecting a slightly higher oil price than we were thinking we were going to get a year ago. And so without wanting to go too much into the sort of arcane details, oil in 2020 was priced at $85 a year ago. Oil in 2020 today is priced at nearly $95, $97. So under the bonnet, the oil price has moved a bit higher. And that's very important for integrated oil companies because their future earnings are contingent on not the oil price today, but the oil price in the future. So I would think, or I should say I would expect even, that the integrated oil sector, those huge oil companies, are actually entering in a bit of a sweeter spot than they've been for a while. For that reason, and the other reason is they're beginning to control their capital investment and focus on their dividends. We keep returning to the dividend argument in a lot of these investment opportunities that I've been talking about. Oil does pay very high dividends. The concerns for the markets in recent years have been those dividends may not be sustained. Now they're cutting capex and controlling spending. Those dividends are likely to be sustained, and therefore integrated oil is not a bad place to be.
Rob, thank you very much.
Pleasure.
This is Emma Wall for Morningstar. Thank you for watching.